Hi there, welcome to Kneppy Invest. One of my favorite sort of companies to invest in are those companies that are quite small but have the potential to grow significantly bigger in the future. Now, in my opinion, and this is just my opinion, the best strategy in this realm of the investing world is not just to buy one company, it's to buy a group of companies that have that potential. And when I say group, I'm talking about 30, 40 like companies, because the majority of these companies more than likely will not become significantly bigger in the long term. And when I say significantly bigger, I'm talking about 10 times bigger. But if you do hold 30 or 40 of these companies, at least one or two of those companies will become big in the end if you do choose wisely. So in today's video, I'm going to bring you two small cap companies that are potential buys. Now, one of these companies I personally own, the other one I do not. And this is part two because I already did a video called Two Small Caps to Buy about 4 or 5 months ago. I think they released it in May. And more than likely, I'm going to do more of these particular videos because the whole point of me doing this channel is just to share ideas with you. And then you take one of these ideas, do your own research to see whether or not the company belongs to have a position in your own portfolio. Before we have a look at the two companies I'll be bringing you in this video, let's go back in time to 2013, 10 years ago, when there was another small cap company on the ASX called Medicus. In 2013, this company had $11 million of revenue and had a market cap of $42 million. Now, this particular chart of Medicus was between 2003 and 2013. And during this 10-year period, the share price of Medicus did absolutely nothing. And sometimes you'll see that in some of these small caps. They do absolutely nothing for a long period of time. Then they hit that inflection point of becoming profitable, growing their revenue, and that's when you see the valuation of these type of companies go through the roof. Now, more than likely, I'm going to probably say in terms of probability, both of these companies, 99% chance they won't become Medicus. In fact, it's probably more like 99.999% chance they won't become the next Medicus. Because for those who don't know anything about Medicus, this is what Medicus looks like right now. In 2023, revenue has grown to 93 million. So not a big growth in revenue, but this company has insane margins. So they've grown their profit every single year. And now the market cap of this company is $6.3 billion. So it's gone from $40 million to $6.3 billion. So this is the type of company I'm looking for. And more than likely, there may be one company on the ASX that has the potential of Medicus. And it's up to us to find that one company. I have no idea what it is. Could it be one of the companies I'll be showing you in today's video? And this chart of Medicus from 2013 to 2023 is the sort of chart you want to see for a long-term hold. The first company I'm going to look at, and the only company I actually do own personally, is called Visan, ticker code VYS. Now, this company is focused on the integration and development of water specialized services and technology. So that does seem like a growth area for the future, particularly because it deals with water. And water is, well, we all know water is a precious commodity. And I think through time, it's going to become a more and more precious commodity, and we're going to want to look after it. And that is something Visan is doing. Their vertically integrated model provides end-to-end water services to the resources, urban development, government, utilities, and agricultural sectors. Their services include hydrogeological drilling, test pumping, reinjection water, and water consulting. They have 4 subsidiaries. By far the biggest and best performing subsidiary is Pentium Hydro. Then they also have Pentium Water, Pentium Test Pumping, and Project Engineering. And when I say by far the best performing subsidiary is Pentium Hydro, if we go back to 2022, $44 million of this company's $46.3 million revenue came through Pentium Hydro. Now, Visan has diversified over the past year. So only $51 million of their $64.9 million of revenue was through Pentium Hydro. Now, this company has made some acquisitions in the past, and that's why they've become more diversified if you look at their revenue and revenue generation. Now to Visan's financial situation, and this company is profitable. And they had $65 million of revenue in financial year 23, which was up 40% from the previous year. Profit, 3.9 million, up 36% from financial year 22. So that's one of the reasons I have taken position in this company, is because of their financial situation and the growth this company has been experiencing over the past few years in terms of revenue. And if they can continue on this momentum, which I fully expect them, I would expect revenue to exceed $100 million in the next few years. Gross margins at 33%, and this company is operating cash flow and free cash flow positive. In fact, operating cash flow positive by $9.3 million. One of the things I look for in all companies is return on equity. And the number I'm looking for when it comes to return on equity is above 10. If I say return on equity being above 10 and staying above 10 over a few years, that is a good sign that a company can become high quality. The other thing I look for also is return on invested capital. But to be fair with you, if you just look at return on equity, that's good enough to decipher whether a company could be or already is high quality. Now onto the chart and some more specifics around Visan. The current share price of this company is around 18 cents. A little bit of volatility in there. Now I'm recording this video at about 3:30 p.m. on the 25th of September. The share price has dropped a little bit today, but the share price has increased significantly over the past 6 months. In fact, in March of this year, share price was actually below 10, more like 9 cents. So the share price and the valuation of this company has more than doubled in about 6 months. Shares an issue of 408 million, and at a share price of 18 cents, the market cap of this company is $73 million. Now, I wouldn't say that's too high or too low. And if you look at the PE ratio, 19.5. So one of the things I also look at is some valuation metrics. And because of this significant increase in valuation, I think fairly valued is probably the best way to describe the value of this company right now. 6 months ago, I probably would have said this company was undervalued. The second company I want to talk about is Stealth Global, ticker code SGI. I'm not a shareholder of this company, but I am going to be following this company a little bit more closely than I have, just because of the goals management have set for financial year 25. And if management can hit those goals, I think this company could be thought of as being undervalued, and maybe even significantly undervalued at current prices. So Stealth Global is a distributor of industrial, safety, truck, automotive, and workplace supplies and other related products and solutions. Some of their subsidiaries or divisions include Heatley's Safety Industrial, C&L Tool Center, Skipper Transport Parts, ISG, which is Industrial Supply Group, and United Tools. I have not heard of any of those companies. And so this company sells power tools, hand tools, glazing, workwear, PPE, footwear, healthcare, also for trucks and trailers, buses, mining, agriculture. And if you do look at their end market, 32.9% of the products and services are for resources, 25.5% for trade and retail, 18.5% for infrastructure and construction, 13.4% for transport, and 7.6% for government and commercial. By far the biggest region in Australia. So this is primarily Australian-based company, if not completely Australian-based company. But 68.3% of the revenue is generated in Western Australia, 17% in Queensland, 8.6% in South Australia, and only 5.8% in New South Wales and Victoria combined. So it does make sense that this company is more focused on resources, because West Australia and Queensland are the resource states in Australia, and they generate most of the revenue for this company. But it would be good to see Stealth Global become more prominent in New South Wales and Victoria. So they do have 3 operating divisions. I'll talk about that in a second, with 70 locations throughout Australia, 18 of which are company owned. Now, the 3 divisions are wholesale, which generates 9% of group sales, retail, which generates 6.6% of group sales, and distribution, which produces the majority of revenue for this company, and that is at 84.4% of group sales. Now onto the financial performance of Stealth Global. And this company produced generated $111 million revenue in financial year 23, up 9% from last year. However, they will have to increase that revenue at greater than 9% per year to achieve their financial year 25 goals. And one of the reasons why I'm going to be following this company a little more closely in the future is because their goals for, for 2025 is $200 million of revenue at 8% EBITDA. And if they can achieve that, and they have 2 years to do it, if they can achieve that, this company at the current valuations should be considered quite undervalued. I'll talk about that in the next slide. Now, margins are fairly small for this company. You can tell they have really low margins by comparing revenue, $111 million, to the profit, which is less than $1 million. But I fully expect the margins to increase, particularly as this company ramps up their revenue. However, in saying that, profit did increase by 50% from last year. Now, that's on a low base, but still 50% growth in profit. Gross margins at 29%. So it's really their net margins, operating margins that are fairly low. And if they can increase gross margins, also increase operating margins, and if they can get to $200 million revenue, that profit number should be significantly higher than $900,000. Now, if we compare profit to operating and free cash flow, this company is generating a fair bit of cash flow in their business. $6.8 million of cash flow in their operations and $6.4 million of free cash flow. Probably one of the red flags about this company is debt. This company does have $7.2 million of net debt. And if I remember correctly, one of the reasons they do have net debt is because of acquisitions they have made in the past. Current share price of Stealth Global is 16 cents. Shares on issue $100 million. So it's really easy to calculate the market cap. All you have to do is times share price by 100 million. So that means the market cap of this company is around 16 million. And that means the PE ratio is 17.8. Now, don't forget, this company doubled their profit from last year to this year. And it wouldn't be surprising to see Stealth Global double their profit in financial year 24 and then double again in financial year 25. And if they can do that, that would mean their profit is about $4 million in financial year 25, which means the PE ratio, the forward-looking PE ratio, would be 4, which is significantly different than PE ratio of 17.8. That is why I'm saying that if they can achieve their goals, this company does look attractively valued at a market cap of $16 million. Now, in saying that, they do have a little bit of debt, which means the enterprise value of this company is more like $23 million. So I think you really got to look at the enterprise value of this company, $23 million. Now onto the chart. There has been a little bit of excitement in this company over the past month or so. Share price has moved up. But if you do look at the long-term chart, and this is the daily chart going back to the middle of 2021, so we're talking about 2 years, share price has really done nothing, going sideways. But if this company can prove their business model, continue to grow their revenue, and also not only grow their revenue, grow their margins or increase their margins, and that means their profitability will increase by a greater amount than their revenue increase, I think this company is attractive. So I am keeping my eye on the performance of this company moving forward. That's all I have for this look at 2 small companies to buy, question mark. The answer to that question mark is for you, not for me. Now, maybe I'm a little bit biased in regards to Vicand because I am a shareholder of that company. And I think there is potential for Stealth Global to possibly be in my portfolio in the future, particularly if they can move towards hitting their goals. If you have any questions, any thoughts about these 2 companies, Vicand and Stealth Global, I'd love to hear your opinions, your thoughts, so leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is not qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.